Thank you for joining the Payroll Solutions for Accounting Professionals Q&A on September 5th, 2019. We have a couple people on with us that are not turning their cameras on. And I have a few questions that I got during chat. Let's see, Gretchen asked, I am helping a client with a QuickBooks cleanup and discovered that back in January, she wrote 2 paychecks without running them through payroll. The check amounts were for gross pay, no withholding, and they weren't included in any state or federal payroll tax filings. How do I correct it? So what this sounds like to me is that they just gave the employees a check and didn't run it through the payroll system at all. So normally the best way to do it is to create a paycheck, or to put, instead of coding those payroll amounts to wages, to move it to employee advance. And then as soon as possible to create a paycheck. Sorry, there's flies in here. I live out in the country. And then as soon as possible, run it through payroll, take out the advance so that the correct taxes can get withheld. And then their W-2s will be correct and the withholding reports will all be correct. But that's how I normally handle that. And usually when I see stuff like this happening, it's when the business owners are trying to run payroll and do the books and everything themselves without fully understanding why things have to be run a certain way. Sometimes they don't realize that they have to use a payroll software or use a template of some sort so that they can get all the proper taxes and everything withheld. Let's see. Coco asks, I need advice on how to proceed with a payroll client. The client is an S Corp, but only takes draws. The previous accountant did not inform the client of the payroll requirement for the S Corp election. And we have agreed to run payrolls going forward. How should I proceed with the cleanup for 2019? A letter has been received requesting quarterly filings. The client has taken draws every week. Their current payroll process or service won't issue a check run earlier than Q3. And they're looking for guidance on how to proceed. The client is aware of my inexperience with payroll and has agreed to allow me to learn through this process. So the payroll service that they're using is correct, that it would not be a good idea to run payroll earlier than Q3, and I would file a 0 return for Q1 and Q2. And the reason for that is because if you're an S Corp, as long as you have a reasonable salary, and it doesn't matter when that salary is paid, it can be monthly, weekly, quarterly, or once a year, I lost my train of thought here. They can take as many distributions as they want. And as long as their salary is reasonable, then they're normally not going to have any ill effects of not having any payroll in certain quarters, especially if they're a seasonal business. It's not, if you don't have money coming in most of the time, you wouldn't have an employee on staff, or you're probably not working in your business nearly as much as if when it's your busy season. So in those cases, it's reasonable to pay yourself less frequently and have 0 returns. All right. All right, now we have Jamie was asking, I need to submit a multiple worksite report to the Department of Labor for a client. They are asking for a head count by location and a wage total by location. I am not clear about what to do about some people who work at multiple locations. I have all the information. In fact, the payroll report even breaks out payroll for each person by location. Do I pick a main location based on which has the highest salary? Do I submit full-time equivalents instead of head count? Do I count people multiple times? And according to the Department of Labor website, under section 5.3 for monthly employment, the monthly employment report for each location or work site on the MWR should be a count of all full and part-time workers who worked and received pay during the time, or for the pay period, which includes the 12th day of the month. So what this is saying is that, you know, just like when, I don't know about other states, but I know the Minnesota website for unemployment. When I say I don't know about other states, I'm just not thinking of them right now. But the Minnesota website for unemployment says that you count your workers and what location they worked on the 12th of the month. And that is what location you put them in. And, you know, if you have somebody who worked and quit on the 11th, then they're not counted as an employee that month. So that would be how you would fill out the multiple work site report for the Department of Labor also, is by who worked in what location on the 12th or the date closest to the 12th. So, you know, if they worked on the 11th and the 13th at the same location, then they would count as worked at that location on that day. Let's see. We've got another question here from Carmen. I'm a payroll lead and I deal quite a bit with California employees. I can't seem to find anything that specifically states commission should be paid at the time of termination, whether voluntary or involuntary. Could someone point me in the right direction? Thank you in advance. So looking at the state of California website, a commission salesperson that was just discharged let me start that over. In the event the commissions have been earned on or before the date of termination or resignation, the employee must complete the necessary, the employer must calculate the correct pay and pay them on the date of termination. Or if the person resigns, then they need, and they don't give a 72-hour notice, the employer has 72 hours to complete the calculations and get that employee paid. So, and that's the way it is with a lot of states. If you are terminated, you're expected to pay the person, whether it's a commission or hours earned, the pay by at the time that you terminate them. And if they quit, then you have, you know, sometimes you still have to get them paid right away. Sometimes it's within 72 hours. And sometimes it's at the next pay date, as long as it's not over so many days away. And most of the time, if you have employees that are getting paid weekly or bi-weekly, then with that requirement, that's not an issue. And then, you know, also in the event of commission salespeople, a lot of times your commissions aren't earned either at the time that you're terminated or that you resign. So the employee handbook will give you information on how long after a person is terminated or quits that they can earn that commission for work that they had done. Because a lot of times the sale is complete, but the company hasn't been paid for the items that were sold. And that is always that's a pretty standard requirement, that the company be paid for the sale before it's paid in commission. Did anybody else have any questions here? There was one more that I wanted to find in the group and talk about. I am just, okay, here. Beth Ann actually posted a Dave Ramsey video. I'm not gonna play the video, but it's in the group so everybody can see it, and then I'll also post a link on this recording so that you can watch it if you would like to. So basically, a husband and wife didn't realize that they had, over 3 years, had been paid $30,000 too much. And they live in the state of California. The reason that they had been paid, and I watched the video a couple of times and I was a little confused, because either the guy wasn't understanding what the story that he was trying to relay, or there was more information there that he was trying to hide. But it sounded like there was an error made with the 401k, and it was supposed to be a one-time reimbursement of an overage paid, but their payroll company had set it up to be ongoing regular salary amount that resulted in her getting overpaid $10,000 a year for 3 years, and nobody caught it. So let's just stop the story here for a second. There's major things that are happening. One, the employee isn't looking at their pay stub, because it is direct deposit, so it's just money going into their bank, and the employee wasn't looking at the pay stub to say, hey, or they either were not noticing or not saying anything when they realized that they were continuously getting this extra money. And two, nobody at the company was paying attention to the reports that were getting sent from the payroll service. There's so many things that went wrong in this version of events, so that the person ended up getting paid $30,000 too much. I mean, just because you have a payroll company running things doesn't mean that you don't have any obligation to make sure that everything is being done correctly. And who was not paying attention to their budgets, and to allow if one worker got overpaid $30,000 because of a 401k error, how many other employees were getting overpaid? And that had to have shown up some flags somewhere along the line, and it should have definitely never gone on for 3 years. Because, you know, not only their weekly payroll, but when they went to get their taxes done, if their salary is, you know, say $50,000 a year and they're getting paid $60,000 a year, and they weren't notified of a raise, that would cause some red flags for me. But then the employer is requiring that they pay that money back. And reviewing the state of California website, it sounds like they cannot recover the overpayment of funds unless the employee agrees to it. And, you know, with direct deposit, a lot of times the direct deposit authorizations will say, you know, that the employer can put money in and they can pull money out to recover overpayment of funds. But even with that written in the direct deposit agreement, a lot of times it still has to be authorized by the employee. So, you know, there is a discussion on the Facebook group for this. And, you know, I would definitely, I interpreted the law in California to be that you cannot require an employee to pay back the funds without their consent. And I would love to hear everybody else's thoughts and opinions on this. Anybody on the call have any thoughts or anything that they want to add to that scenario? Okay, well, we will end the call. So thank you for joining us today.